Okay, hi there. Welcome to a new 2021 revision update. This time looking at the key concept of economic growth. In this resource, we're going to be covering some of the key causes of growth and look at how the coronavirus pandemic has hit growth in specific countries and the world economy. First of all, a quick mention of our self-paced, on-demand student courses in economics. We'll post a link to Economics on Demand in the comment section of this video. Our courses are a fantastic way of increasing your grade potential in A-level and IB economics, specifically by improving your exam technique and also, of course, key subject knowledge. So we start with some important definitions. Economic growth to most economists is the annual percentage change in the level of real national output. That's the level of GDP adjusted for the effects of inflation. Now, growth is a long-term concept and it's defined as an improvement in the long-run increase in productive capacity or potential national output. Although, of course, there's also a short-term rate of growth when you consider the economic or the business cycle. So what's happened to real GDP growth for the UK over the last decade or so? Well, this chart gives us the information, including a forecast for 2021, and you can see here the extent of the scale of the fall in output in national output forecast for 2020 as a result of the pandemic. The UK's growth rate was slowing from 2014 onwards down to below 1.5% in 2019, but in 2020 the forecast is that GDP has shrunk by more than 10%, the deepest recession experienced by the UK for over 300 years and more than twice as big as the contraction in GDP brought about by the 2008 global financial crisis. There's a rebound forecast in 2021, perhaps helped by the rollout of the vaccine, but national output will still be well below 2019 levels when we reach the end of 2021. This table, on the other hand, shows countries that are growing very quickly. It shows the fastest growing economies in the world in 2019, shown on the left-hand side here. Note that they're all emerging developing countries, including countries like Rwanda and Bangladesh and Ghana, growing in excess of 7% per year. Now, the trend rate of growth of those countries is pretty high. It's always much lower in high-income advanced countries, which don't tend to grow as quickly. On the right hand side is the growth of GDP for the world economy as a whole, and again you can see the impact of the pandemic having a huge hit on global growth in 2020, although the IMF is forecasting quite a big pickup in growth in 2021. The IMF, the International Monetary Fund, has said that 2020 is the worst recession for the world economy since the Great Depression of the early 1930s. Chinese growth, for example, by some measures, the second or the biggest economy in the world. Chinese growth is shown in this chart. Now, it was slowing before the pandemic, but notice what happened in 2020. Growth has fallen to 1.9%. Indeed, they've avoided a full-blown recession in a technical sense, and they're forecasting a recovery in 2021. So even the great powerhouse economy, China, has suffered a substantial drop-off in growth in 2020, although they've avoided recession in a technical sense. What about India? Well, India has been badly hit by the pandemic with a forecast decline of more than 10% in 2020. So the fast-growing Indian economy has taken a big hit in the previous year. Now, when we think about the causes of growth, we focus on short-term and longer-term causes of growth. So let me take you through each in turn. The short-term causes of growth tend to focus on factors affecting aggregate demand and short-run aggregate supply. And these causes are mainly cyclical and policy-induced. So let's take the growth of fast growth of a country. Why might a country experience a pickup, an acceleration in the rate of growth of GDP? One could be that monetary policy operated by central banks is extremely expansionary. Perhaps central banks have cut their interest rates or expanded their policy of quantitative easing, but an expansionary monetary policy, in particular involving low interest rates, could stimulate short-term demand and output growth. The government, through fiscal policy, might also act as a stimulant to short-term growth. They might cut direct and indirect taxes. They might increase their own spending and how much they borrow as a fiscal stimulus to pick up demand and output. So monetary and fiscal policy, when they're both expansionary, can have quite a significant effect on the rate of growth in the short term. So too can a very favourable exchange rate. A fall in the exchange rate, a depreciation, makes a country's exports cheaper when priced in a foreign currency. And exports, of course, are an injection of demand into the circular flow of income. So a competitive exchange rate can be a stimulus to growth. So too can a period of strong growth of asset prices. You see, if property prices, house prices and share values are going up, that could lead to the positive wealth effect, driving increased consumer spending and borrowing money. And once an economy grows, of course, output increases, employment expands, and the more people are in work, and if their real incomes are going up as well, that's going to be an added impact on the short-term growth rate. Business confidence is a key factor. Keynesian animal spirits. When confidence is increasing, that can lead to higher capital investment spending. And we know that countries are connected. There's an interconnection between economies. So if your major trade partner is enjoying a boom, you may well export more to them, adding to export sales. And of course, that's exports is part of aggregate demand as well. Central banks have cut their main policy interest rates in response to the pandemic. But as this chart shows, when COVID-19 hit in the spring of 2020, although some countries did cut interest rates, in reality, there was little room for deep reductions in interest rates because they'd remained at ultra low levels since the global financial crisis of a decade ago. This analysis diagram can be used in an exam to help illustrate short-term growth. So use your aggregate demand, aggregate supply curves here. I've drawn, can you see, an outward shift of aggregate demand from AD1 to AD2, perhaps as a result of an increase in real incomes or consumer sentiment. And that leads to an expansion of aggregate supply, causing a higher equilibrium level of GDP or short-term growth. Now, this is the picture for the UK. This is the economic cycle for the UK, again, since 2008. And you can see that the recession in 2009 brought about by the aftermath of the global financial crisis. GDP, I think, fell by something like 4 to 5%. Then a slow recovery initially, a fairly shallow recovery, picking up in 2013, 2014. The economy then started to slow down once more. It only grew by 1.5%. in 2019, and then it falls off the cliff, the deep cut in national output in the first 2 quarters in particular of 2020. Now, there has been a rebound in output shown by this chart, partly as the economy has reopened following the first lockdown, but of course the big worry is that future lockdowns, the growth of the second and possible third waves of the pandemic, will cause a second sharp decline in GDP. We wait to see what happens in the first half, for example, of 2021. Consumer confidence is a key factor driving short-term growth. And this is what's called a consumer confidence index. It's published by Nielsen. The numbers may not mean too much, but basically an index above 100 means that on balance, consumers in a particular country are optimistic about their economic situation, whereas a value below 100 indicates the opposite, that consumers, people in households, are pessimistic, are worried about the economic situation. And you can see in July of 2020 that most countries, in the leading countries, consumer optimism was well below 100. India bucking the trend a little bit, so too the United States and China, but the UK, the Eurozone, Brazil and France well below 100, as people were worried about the impact of the pandemic on their own families' finances, their job security and the future. Now, what about long-term growth? Let's focus on this for a few minutes. What are the key factors causing a country's productive potential national output to increase? Well, I'm going to mention here 5 key points. The key is to improve the quantity and the quality of the factors of production. So long-term causes include an increase in investment spending. So if you're getting investment, either domestic or external, coming into a country, that can increase your productive capacity. So too can the growth of the country's labour supply. That can be due to demographic factors and natural growth of population of working age. It can also be the result of a strong inflow, net inward migration of labour, particularly skilled workers. The third factor is if you become more efficient. So if you can achieve an increase in factor productivity, perhaps measured by GDP per hour worked or output per person employed. So improving productivity is a key factor underpinning the growth rate of a country. And so too are the spillovers, the externalities from invention and innovation. You see, new products, new processes can kickstart a country. New products generate new demand that wasn't there before. New processes can reduce costs, and it means you can make more with less. And we should not forget also the important role that government can play in driving the long-term growth of a country. So there are potential growth benefits from increased spending on public goods, including things like flood defence and national defence, merit goods, education and healthcare, and other essential infrastructure that countries need to supply a growing economy. A couple of examples here, I think, of following social media. James Hall, the Reuters Africa correspondent, is quite brilliant at picking up examples of growth enhancing news. Good example here of the positive impact of foreign direct investment into the Rwandan economy, having it growing by more than 7% a year. Skoll taking over a local beer making plant, boosting production, and expects production to increase 1 million litres of beers and mineral waters by 2025. And here, investment in Morocco to increase capacity in renewables. And of course, it adds to both aggregate demand, particularly if they start selling the exported energy, and also aggregate supply, an increase in productive capacity in the energy sector. Which countries in the world are leaders in terms of innovation, high-tech businesses and things? This is a recent ranking by Bloomberg showing the most innovative countries in the world by a variety of factors. Germany has actually just overtaken South Korea, which had been head of the charts for the last sort of 6 years. Now this ranking, Germany, South Korea, Singapore, the very successful countries here, includes factors such as research and development spending, the number of patent applications, how many high-tech companies a country has. And these countries here are high income, highly successful, very innovative economies, and these are key factors driving their long-run aggregate supply. How do we show this in a diagram? Well, you're looking to shift out your potential national output from LRS1 to LRS2. That then allows you to operate at a higher level of demand. I've shifted out AD to AD2 there without there being a rise in inflation. So an outward shift in productive potential signifies real economic growth. In the long term, it's based on the state of technology, the quantity and the quality, the productivity of your factor inputs. Finally, I just want to take a moment to showcase our superb printed workbooks for economics. More workbooks and flashcards in the pipeline in the early part of 2021. And again, I'll post a link to these superb books, calculation books, knowledge books, awareness books in the comments section of this video. Okay, thanks for working through this first lesson in 2021, looking at the economics of growth.